Silicon Valley Bank. They had to pull deposits out to pay for the costs that they needed to run their business. But then they also started panicking that they were seeing a situation where Silicon Valley Bank may not have been as prepared. Now, I won't get into the whole area of wokeness in America, the idea of that it's important to hire people that are diverse and of different backgrounds and all that bullshit. I won't talk about that because ultimately it's a nonsense theory in the world of capitalism. In the world of capitalism, we believe to hire the smartest, best people for the job. And it doesn't make sense in capitalism that, you know, let's just say there's brilliant women out there that are totally qualified for the job and a capitalist could hire them at 30% less than men. That's just not something that makes a lot of sense in capitalism. Capitalists will buy those women out of the market and deploy them. Now, there are, you know, cases, I would argue, that, you know, where we do have inequalities and stupid people doing stupid things. But generally in capitalism, we need the best man or woman on the job. And particularly when it comes to risk management of a bank's balance sheet, my God, that is super, super tough stuff. So I won't get into that. And so now we come to what's the government's response. So the government's response basically, in a capitalist system, what would have happened is that this bank would have gone bust. And the depositors who deposited their money would have lost their money. But we have the FDIC, the Federal Depository Insurance Corporation, and the FDIC basically tries to guarantee the deposits up to $250,000 US. So, okay, no problem. We have an insurance company. So instead of 90, now also remember, this is a bank that is taking deposits from corporates. So the guarantee really is only up to $250,000 for deposits. And basically these corporates had billions, you know, millions of dollars in deposits. So what would have happened is that insurance would have kicked in and they would have basically been able to, you know, they basically would have been able to have lost a smaller amount, but most of their money. Of course, a lot of startups would shut down. A lot of companies would shut down. And then, you know, things would continue on. But of course, now we have a woke agenda in a government. And so they don't want anybody to suffer pain. So they're going to come in and try to save the day. So what did they do? They basically came in and they said, all right, here's what we're going to do. All the bonds that you're holding that have massive losses sitting there, unrealized losses, we're going to buy them at face value, meaning you bought them for 100. We're going to buy them for 100, even though they're worth, let's say, 70. And we're going to hold those bonds. Government's going to hold them for a year. Now, this is a good one because the Fed is saying, we'll hold them for a year and then you've got to, you know, take them back in some way. Now, the hope is that if interest rates start to fall in the next 12 months, then the unrealized losses turn to be less and less and less. So maybe the Fed knows something that we don't know, which is that they're eventually going to be lowering interest rates in the next 12 months. And so those losses, now, if the Fed doesn't lower interest rates, you've got a certain amount of losses that those banks have to figure out how they're going to bear those losses. But we know the way kind of woke government works is that they'll just, if the interest rates have not come down yet and the banks would have had to deal with those losses, then what they would have said is, oh, let's extend it for the maturity of all those bonds. So it's a 3-year bond. They hold it to maturity and voila, trouble's gone. Seems like a brilliant thing. However, what happens and what they're trying to do is prevent people from saying, holy crap, my bank may be having this problem. I'm going to take my bank out of this small, piddly little bank that I have my deposits in, and I'm going to move it into JP Morgan as an example. So now we have a huge amount of people who are trying to take their deposits out of the banks that they think are at risk and shift them into the higher quality, bigger banks. Now, this is going to force other banks to have to sell their bonds at a loss. And then all of a sudden you got 100 banks going bust this week, maybe 500. Remember, there's about 5,000 banks in the US. And so now you've got this issue. So what did the Fed do? They basically said, okay, any bank, not just Silicon Valley Bank, but any bank can just, all you got to do is take that bond that you have at 100 and it's valued at 70, just sell it to us at 100. We'll buy it. We'll buy it 30% higher than what it's worth. So the Fed has now set up a facility where they're buying bonds. And as we speak, maybe hundreds, if not 500 banks are selling these bonds to the Fed and getting paid the full price on these bonds. Now, of course, the government is saying, hey, it's not going to come from taxpayer money. Well, that's a bold-faced lie, because everything that the government does comes from taxpayer money. And then they say, well, no, but it's going to come out of this fund where other banks have to contribute to this fund. Yeah, well, they're going to pass that on to us consumers. So that reminds me of when I heard Joe Biden say he didn't blow up Nord Stream 2. Just kind of a flat out lie, straight to your face, type of thing. So here we have a situation where they have technically stopped the risk of a bank run. In theory, that's good. It's well-intentioned. As Milton Friedman said, is that the mistake we make about government programs is judging them by their intentions, not their outcomes. And all government policies have good intentions, but they lead to all kinds of unintended consequences. Now, there is a little twist to this story that's interesting, and that is there's a guy named Barney Frank. Barney Frank was a representative in Congress for many years from Massachusetts. And when the 2008-2009 crisis happened, what did Barney Frank do? He wrote out the legislation called the Dodd-Frank legislation to stop future banking crises and protect the stability of the banking system. And he did a really nasty trick, which is when the banks basically convinced the Fed and the Treasury that they should be called, the largest banks should be called systemically important banks, right? And in other words, too big to fail. This is the best marketing strategy that the banking sector has ever done. And they sold the government on it, and then they sold it out to the population. And Barney Frank was involved in the Dodd-Frank legislation, which codified this, that there's certain institutions that are too big to fail. And for anybody that banks with a big institution, how shitty they get. The bigger they get, the worse they get. And any level of competition. I mean, I worked in Citibank, and if somebody wanted to start a bank doing mortgage loans and competing against Citibank, they could have taken away half of our business, just like that, with good service, good quality, and all of that. But, they're not allowed to do that because of now they're systemically protected. So that raises a whole nother level of moral hazard. But the irony about this whole story is that another bank in New York, another Democrat-controlled state, New York, California, Silicon Valley Bank, and New York Signature Bank, this bank also went bust at the same time as Silicon Valley Bank. Now, it wasn't as exposed to the Silicon Valley, companies, but it was exposed to some other things. Particularly, they were telling about how they were really great at lending out to low-income people. Well, that raises a whole nother problem, which is outlined in this book very clearly, called Hidden in Plain Sight. And this book outlines exactly what happened, and that is the government, again, with excellent intended consequences, the intended consequences was to get more and more people to be able to buy houses. So they pushed Fannie Mae and Freddie Mac, which were buying mortgages from the banks. They pushed them to have lower and lower and lower quality mortgages so that more lower income people could buy mortgages, and then they could vote for the Democrats and say, they got me into this house. Well, they pushed massively, and the amount of bad loans that went into the system was incredible. In addition, everybody knew that the lower of the quality that was required was going to cause massive losses. In addition, when you bring access to borrowing for houses to millions of people that never had access because they're lower quality, you also all of a sudden bring 5 million new people buying houses. What happens? The demand for houses rises, but the supply doesn't change. The price of housing went skyrocket high, and that is the cause of the 2007 mortgage boom that landed us in an awful, awful 2008 bust. Of course, government officials will blame it on greedy bankers, but governments set these things in motion. But to go back to the story of Silicon Valley Bank, the irony is that Barney Frank was on the board of Signature Bank. Incredible, incredible. the guy that was supposed to save us from, you know, the banking sector and set all the legislation. And there he was crashing his bank into the ground and then getting it to get government support. So now we're in a situation where we have government.
As they say, you can't make this shit up.
You can't make it up. You can't make it up. And so all you can do is just kind of smile and think, holy crap. But to wrap all of this up, the point is that the government has probably averted a crisis by shifting funds of people that are panicking into the larger bank. And if you look at the ETFs, particularly like the ETFs are funds that we own in the banking sector, which we just recently went overweight banks. We didn't go overweight, but we added banks to our position. Those are concentrated in the largest banks. So it's very possible that the funds and the ETFs will actually do better as they get more market share. And I expect the financials to bounce back from this. So now I would say from a longer term perspective, this could be the canary in the coal mine. This could be the thing that tells us, hey, you know, there's something coming. And I think that there's a real risk of that. And so we are every day, Alex and Sorensen and myself are reviewing our positioning, but also remember that in our different strategies, the all-weather strategy, the alpha focus strategy, we have a 7% allocation to financials. And in the inflation guard strategy, we have a 5% allocation to financials. But remember that we also have strong diversification. So we have 25% in gold as an example, and gold is rising. You know, we got 10% sometimes in gold, sometimes 5%, sometimes 25%. But the point is we have different asset classes that are offsetting that. So that's the reason why we haven't gone and rushed to do anything, because I think with the moves by the Fed and funds potentially shifting into the largest banks, that the portfolio actually won't be damaged by much. But that doesn't mean that we won't make a change to that in the future. So I think I'll wrap up my talk on that there and see if there's any questions or comments.
What about the value of dollar then?
The value of the dollar?
Yep.
Well,
it's
once
QE
again,
infinity, right?
What's that?
It's QE in infinity, right? They're printing money, right?
Ultimately, it's kind of bringing us back to QE, which I think eventually we're going to be at, where I think that what's going to happen is that a few other things are going to break, and eventually the Fed's going to have to start to lower rates. And then the market's going to fly. And it's one of the reasons why I'm hesitant to be underweight the U.S. equity. I think that we're heading into a potential recession, but what's going to happen is that the Fed's going to, going to reverse course. And then when the U.S. goes into recession and the rest of the world goes into recession, but it's only the U.S. that can prop up its stock market through QE programs and prop up its economy. And ultimately, you have the risk that the U.S. dollar gets stronger before it gets weaker. And you run into another 6 to 12 month period where the U.S. dollar is strong. And I think that's very possible. For those people that are thinking to themselves, well, yeah, but eventually the U.S. dollar is going to fall because it's too much debt, it's too much spending, it's military across the world and all that. Yeah, those things take 5 to 10 years. You could be right on that, but if you're really early on that trade, you could be killed, over a period of time. And that's the reason why I'm not bringing a really strong position one way or another on the dollar. Although I agree that the dollar, I think, is eventually going to fall. I think the deal with China, brokering some sort of peace between Saudi Arabia and Iran is a major thing. And it's a little bit like Donald Trump. The Democrats will like anything except if it was spoken from the words of Donald Trump. It could be their policy. I mean, Donald Trump's, he's a freaking genius. All he has to do is take the Democrats' #1 policy and say, that's what I want to do. And they're going to say, we're not going to do that. And they're going to hate it because he said it. Well, it's the same thing with the Chinese peace between Saudi Arabia and Iran. Expect that the American politicians will say, that's no good and we've got to break that up. So anyways, I would argue probably dollar strength or no dollar collapse for a while. Because the other part of tonight is looking at inflation, and inflation's coming down in the US and it's staying high around the world.
But is it doctored?
I would say that could bring us into a little bit of discussion on inflation. How about if we look at that? I don't think it's doctored. You know, are there weaknesses to US inflation data? Definitely. But I wouldn't say that it's doctored. Let's do this. Okay, before I go into inflation, are there any other questions or comments related to the SVB and the banks and all that? Been excited all day wanting to talk about this stuff. I miss my job as an analyst. You know, what I did every single morning was wake up and think, what is a freaking story I want to tell? And then how do I write that out? And how do I publish it? And how do I speak it out? And that's what I loved about being a sell-side analyst. All right.
So there might not be any more bank run, right?
I think that what they've done is probably going to stop the bank runs. Because if there's any bank run on a bank, all they got to do is go to the Fed and pledge their securities. Now, it's possible that if a bank was so stupid as to buy non-government bonds, right? So they have a huge amount of bond portfolio and it's high risk or low quality corporate bonds. Well, the Fed's not going to buy those.
Okay, one more thing. There might not be a bank run, but banks might collapse. Small banks might collapse.
There'll be some collapse. Yeah, I mean, you're shaking the system pretty hard. So, you know, let's say 50 banks collapse, 20 banks collapse. But let's just talk about that for a second. Before the Fed put this program into place, then you could see a bank collapse, right? And what happens when a bank collapses in America is that basically think about the asset side of the balance or the liability side of the balance sheets, all deposits, right? Banks get their money from depositors. Think of how hard banks work to get depositors. They work so hard. Now, if you are a bank and you're competing against a dummy, stupid bank, let's call it bank of wokeness that doesn't put any, you know, risk management in place, and you're competing for the same depositors, and all of a sudden, bank of wokeness goes bust because some depositors want to take their money out, but not all of them can get their money out. So most of the depositors are there with their money in. The FDIC comes in and they say, okay, well, we've got two problems. We've got the liability side of this bad bank, let's say the bank of wokeness. This bad bank has all of these depositors that are trying to take out their deposits and the bank owes them. And on the liability side, we have assets that the bank's holding that's worth less. So the hole is on the asset side of the balance sheet, right? And so if there's a hole on the asset side of the balance sheet, what the FDIC can do is they can go to the competing bank, the competitor that's competing for those same depositors. And they've been fighting Bank of Wokeness for a long time. And now Bank of Wokeness just went bust. Now basically the FDIC will go to all those depositors. They'll go to the bank, the good bank, and they'll say, okay, we'll take all those depositors. And all the depositors will go to the good bank. And now they're on board. Just like I was at the bank, I was banking with Citibank, and now I'm with UOB because UOB bought those loans. Now, the only problem is the hole in the balance sheet on the assets side. And that's not the problem of the good bank. That's the FDIC that has to figure out what we're going to do to make sure that we collect this money, whether that's bad loans or whether that's securities. And so the hole is going to be covered by the FDIC in the case of a bank failure in America. So that was before this legislation happened. now that this not legislation, but this rule, and I talked with a friend of mine, he was saying he even thinks that it could even be not constitutional. Because you think about it, this new rule by the Fed, the Treasury, and the FDIC, they jointly announced this facility. Basically, if this facility was available a week ago, Silicon Valley Bank could have applied and they wouldn't have died because they could have pledged their securities and given them to the Fed and gotten cash, use that cash to pay out their depositors and say, go ahead and take your money out. We've got cash as much as needed. But it wasn't available. In fact, you could argue that Silicon Valley Bank could sue the government and say, hey, wait a minute, you're giving a favor to all the banks that were going to go bust, but didn't because you passed that legislation. You need to compensate us. There may be lawsuits like that. But now that that legislation's in, or that rule is in place, that facility is in place, now Bank of Wokeness in rural America that's getting people taking money out of the bank. And now they're starting to wonder, oh, crap. All of a sudden, these are not held to maturity government bonds. They're, available for sale, and we've got to sell them to get the cash necessary. And we bought 10-year bonds, and those 10-year bonds have already fallen 30% in price. If we sell them now, that's a loss that we have to realize in our P&L, and that's a loss that we have to realize as a loss of capital. And then we're going to run out of capital, and the bank's going to go bust. And so now all they have to do is just go to the government, give them those bonds. The government gives them 100% of the face value. They pay back the depositors to calm things down. Depositors go, yeah, I got my money. It's no problem. And I even went back and put my money back in, So I would say that they probably stopped that from happening. Still, other things are going to break. And this is part of what I keep saying. I was like talking to Alex when we were presenting last night, and other times I'm like, we keep saying some of the same things over and over again, like I like, are people just getting bored of the same freaking thing? Like we keep saying, yep. And the central bank is going to break something at some point. And I was watching the thing that they were going to break was, as we say that in the military, they're always fighting the last war and they don't realize where the next problem's coming from. And we were looking, of course, at bond yields. And we were seeing that the government did intervene in the bond market. The Fed did buy bonds, which they're not supposed to do. And they bought bonds in the US bond market to protect the bond market from collapsing bond prices. Because, it's a nanny state where the government has to protect everybody from loss, right? So the Fed went in and they played nanny and they protected them from loss. And basically that's where things started to break last time. And here we have another break in the bond market and the Fed buying bonds. In this case, they're buying them not from directly in the market, in the bond market, but they're buying them directly from the banks. Arthur, you going to say something?
Yes. Actually, I was just going to ask you about the bond. You just mentioned this now, that this year it's pretty high. Like beginning of March, it's went up to like 5%. So does this going to lead to stronger USD? I mean, in the year, stronger.
No, I would say that the rise in the bond market is already reflected in the US dollar. Right? That's been reflected as we see expectations of bond yields are rising. And so remember, it's always future that the market's looking at. So truthfully, I think that it's very possible that now, in fact, Alex produced a chart that we were looking at that showed that actually the expectation of the Fed target rates is already collapsing from where it was just before Silicon Valley Bank. That means the market is actually anticipating a potential fall in the interest rate, that the Fed can't tighten anymore. They're going to break more things and rates are going to have to come down. And so that's already starting to be reflected. And therefore, you could argue that weakens the dollar a bit relative to other currencies, right?
Something to look forward to.
Oh, yes. Yep. All right. Yep. All right. I want to share a little bit on CPI, and I've been working on making a chart book for you guys, and it takes time. I got to do it kind of month by month and improve it and get it ready. But the way I think I'm going to do it now is that basically around this time in the middle of the month, we get US CPI for the prior month. So that means it's the middle of March and we're getting US CPI for February. but globally, CPI is a lot slower to be announced in other countries. And so by this time, we also have January CPI for all countries. So we can look at US February and the rest of the world January. And that's the way I'm going to create the chart book that we're going to provide to you guys. So let's take a look at that chart book a little bit and see what it's saying. I'm not done with it. I still got to do a little bit more, but basically what we can see is that February 2023 CPI was 6%, which is down from 6.4 in January and off from its peak that it was at 9.1 in June 2022. So yeah, is it possible that inflation or CPI, I call it CPI because it's a little bit different from the concept of inflation, but is it possible that this CPI is understated? It's possible that it could be much higher. Now, food accounts for about 13.5% of CPI and was high at 9.5%. Here we can see that food has come off its August 2022 11.4 peak. So food shot up above overall inflation and is starting to come down. Now, energy accounts for just 7% of US CPI and was up only 5.2%. So let's look at that. Here's the energy component in blue of CPI, and we can see it's mainly driven by oil price, and it's been crashing down. And so now it's coming down below what CPI is overall. Now, when oil prices, so now what I've done is I've looked at a 12-month moving average of oil, US CPI, and energy. So when oil prices rise, it causes a similar but muted response in the US CPI energy component. The correlation between oil price and energy component of CPI is 90%. So when oil price moves, it eventually moves US CPI. And basically, food and energy are a tiny part of US CPI. 79% of the weight comes from all other items, and those were up by 5.5%. So food and energy tend to be highly volatile and now have come back in line with total CPI. Actually, what I meant to say was X food and energy. So US CPI, excluding food and energy, is come back down. Now, here we can see that most volatility in US CPI comes from the energy component, even though, as I said, it only accounts for 7% of US CPI. Now, I haven't finished this report yet, so I still have some titles that I haven't gone in, but this tries to look at what's happening with US CPI and housing prices. And here we can see the green line, and housing prices have been collapsing, of course, and oil prices have been collapsing. So it's hard, Amit, when you talk about CPI, it's hard to make an argument that CPI is going to go up in America when you can see how much housing prices have come down. Now, this is housing price. It's not the component of housing in CPI. That's much more slow to adjust. But here you can see a massive down cycle in housing prices and a massive down cycle in oil prices. Makes you think, no, US CPI is not going to go up right now. Now let's look at food for a second. So let's break down that 13.5 into food at home and food away from home. Food at home accounts for about 8.7, and then food away from home accounts for 4.8. And both of them are up high, but food at home is up 10.2%. So now we can look at food and the food at home component, which is higher than the overall food. And then we can see food away from home is what's a little bit lower there. Now, we can also look at this energy component, but keep in mind, it's kind of amazing when you look at it. This is the breakdown of US CPI. Food, which we just looked at, and energy, which we're going to look at now. Food is 13.5, and that's how it breaks down. And energy is 7.1, and this is how it breaks down. What we can see is energy commodities have gone negative. That's because of falling oil prices. Remember, this is commodities. So this is the oil price related movement. And then services is like utilities, the bills that were charged at our factories and our homes. And this one's actually still the highest component so far of all the different components. And that's because it takes a long time for that higher energy price to feed through. So here we can see what's happening with energy, gasoline, and electricity prices. But the main thing you can see is that gasoline is crashing down, and that's bringing overall energy down. And then finally, the 79.4 component breaks down into 21 and 58. This is where shelter, or what we call owner's equivalent rent, is about 34% of that 58. And that's still staying up at about 7.3 versus commodities like vehicles and apparel, which is now down at only 1%. And here we can see commodities excluding food and energy commodities is the green line. That's collapsed quite significantly. And services, less energy services, is the light, the dotted one. And that actually continues to be high as the oil price continues to take time to feed into that. So that is the US CPI. I just wanted to look at what's happening around the world. We can see this is January of 2023. CPI was 7.4 in the world, and it was 6.9 in the developed markets and 8.2% in emerging markets. So what we can see was CPI was 7.4%, up 2.1% year on year. And month on month, the developed market is falling. We can see that interest rates in developed markets, or CPI in developed markets, are falling. But as our friend Momin here in this call, as an example, or maybe Mercy or others who are in Nigeria, may be experiencing rising inflation in emerging or frontier markets. So if we look at the Americas and Europe and the Pacific, these are the developed market regions. We can see in the Americas, inflation is 6.3. In Europe, it's 8.3. And in Pacific, it's 5.1. It's so low in the Pacific because of Japan. So here we can see what's happening. The big bold one is the world. And we can see that developed market Americas is actually rising. And we can see that the developed market Pacific is falling. So here we can now look at the emerging world, which is Americas, Asia, Europe, Middle East, and Africa, and frontier markets. And you can just see, look at some of these, right? Europe, 23%. Middle East and Africa, 10%, and frontier markets, 30%. That's massive. Now, emerging markets, Asia is mainly China. Developed markets, Pacific, is mainly Japan. So here we can get a picture of what's happening. In frontier markets, the inflation just keeps rising. In the emerging markets, Middle East and Africa emerging markets, it's rising. But in emerging markets, Europe, it's starting to fall. And that's partially because we can see oil prices or gas prices in Europe falling. And then we can look at the different countries, but let's just look at the top 5 developed market countries in the world. Only the US CPI is falling year on year. UK has started falling month on month, and Germany, Japan, and France are actually rising. So interest rates are kind of still rising in the developed markets. To some extent, it's offset by a massive fall in the US. And let's just look at emerging markets, which is on the right. We can look at some of these. The top 5 is China, India, Korea, Russia, Brazil. And we can see that the blue line here, India, we can see that inflation is starting to rise. China has got a little rise in inflation, but I expect that that will eventually come up, particularly as China opens up. And some other charts. I used that graphic because I thought it was kind of fun. These are developed market highest. So the countries with the highest inflation or CPI: Sweden, Austria, Italy, UK, Germany. Here's the developed markets with the lowest. We can see Hong Kong, very low, Switzerland, Japan, Israel, Spain. Spain's come down quite a bit. Here's the developed markets that have the biggest rise, and they've all risen to above the world average. So Sweden, Austria, Italy, Portugal, Germany. And here's the developed markets with the smallest rise. These have either been falling or they're flat, like US, Spain, Belgium, New Zealand, Canada. Here's now emerging markets, and these are the ones with the highest level of CPI. So Argentina, Turkey, Sri Lanka, Pakistan, and Egypt. And you can see Egypt's been rising recently. And Momin, you thought it was bad in Egypt. Now look at some of these other countries like Sri Lanka, like Turkey, like Argentina. So here we can see emerging markets that have the lowest. And right now it's China that has the lowest level of CPI amongst all the emerging countries. And I would say that that's eventually going to come up. But we can see Jordan as an example, as well as Malaysia, pretty high, but they've both been falling a bit. And the largest rise, of course, was Argentina, followed by Sri Lanka, and then Egypt, Hungary, and Pakistan for emerging markets. And then the smallest rise or even fall was of the emerging markets was Brazil. Now, Brazil is an interesting one because they've been through it before. They knew to increase interest rates real quickly to try to bring down inflation. We can also see that the smallest rise was Taiwan, India, Mexico, Greece. So that gives a picture of what's happening with interest rates, inflation. Any questions on that? I'm trying to put it together and then publish it tomorrow. Amit just tries to bring it down to the point. Will the Fed hike?
And what will affect to Thailand?
So one of the questions is, does all of this affect Thai banks? And I would say no. Thai banks are not in this type of situation, and they've already survived a pretty brutal time. So from a bank perspective, I'm not too worried about Thailand. I would say that the Fed probably is getting scared that they're breaking things. And that means that they may not raise rates by much. So if I had to bet, I would say 0.25 to 0.5% rate hike to show that they're still trying to deal with inflation. And remember, what the Fed's trying to do is say that inflation is the job of the government. And all of the government spending is what's causing a lot of this inflation. And therefore, we're going to keep raising rates, and the government needs to do something to bring down inflation. So I would say my expectation is 25 to 50 basis points on the next one. But the market expectation, I would say, is coming down. And maybe market expectation is going to be close to zero, no increase.
Yeah, it's about, I think, 10 to 20% on unchanged, and then about 70, 80 or 0.25. But that changed. Like before Silicon Valley Bank, you had those probabilities, but for 0.25 and 0.5.
Yeah, so the market's not expecting, but I would say that my expectation is they're probably going to try to raise rates a bit, but we'll see. As far as Thailand's concerned, Thailand inflation is coming down and rates never went up so high. Thailand didn't pump a lot of money into their economy, and Thailand's not experiencing import inflation the way, for instance, let's say Egypt or some of the other frontier markets that don't necessarily produce their own food or something like that, like Pakistan as an example, Sri Lanka is an example where domestic economies are small and they're very reliant on imports. And I would say those are, Thailand's not nearly hit as much. So I haven't really looked at the Thai market and the Thai rates in a lot of detail, but I would say there's not a lot of pressure coming on the Thai rates. And in fact, if interest rates start to come down in America, then that takes pressure off of Thailand to, raise rates. So I would say either flat or even down potentially for Thai rates for the next 6 to 12 months.
Thank you.
Other questions? It's a fun night.
So can I
I think
ask
the Fed will
another?
raise
You think it's going to raise by
Yes.
what?
because since there's a backstop already and they're buying all the bonds, they need to show that they mean business
Yep.
in order to protect the dollar and everything also. They need to show they mean business. Otherwise, Fed is a lame duck then.
But look at
You
all
can't
that.
stop halfway.
Look at all that data on CPI. You see all those charts coming down.
Yeah, but six 6% last year was a big deal, and 6% this year is not a big deal.
Yeah. I'm actually in
It's still a
agreement with
big
you,
deal.
right? I'm in agreement. I think that the Fed is going to raise because I think they want to show that they're tough. And I think that Powell knows that you want to go down in history as the asshole who raised the rates to protect the country from inflation. So I think that you're probably right, but the market expectation is not. Japan, right now we're doing our global investment strategy report, and I can say I don't have a strong understanding about Japan's yield control and all that. All I can see is inflation is going, higher and higher, and that's potentially stimulating the economy in Japan, but also, potentially hitting the currency, and how long they can have high levels of inflation and not move the interest rates, I just don't know. And just the fact that the government is so deep into debt, really, I got to do some work on that to answer that from a smarter perspective. Okay, and I'm gonna read out your name here on there. Tisa Gone. You got to turn on that mic. Okay.
Yes, these are gone. Yeah, so it's just so that the Thai market drops a lot, the Thai stock market, I mean, but you're not mentioning it here, right? So maybe we talk about this another.
Yeah, I mean, one of the things that you see is that the emerging markets like Thailand and others are very volatile. So when there's a panic, going on, they can get hit pretty hard. People may be panicking about Thai banks. People may be panicking about, this brings us closer to a recession in the US. And if the US goes into recession, then Thailand goes into recession. So I'm not exactly sure what the rumor mill is talking about in Thailand today, just because I'm not tapped into that these days. Does anybody know what people are saying in Thailand about why the market's coming down?
I saw they said that the Thai bank stock drops a lot, and then all the big cap, the foreign fund, they sold the Thai stock.
Yeah, and I would say, Thai banks don't have such a huge portfolio of bonds, number one. And number two, there's not a run on deposits that's forcing Thai banks to sell those bonds. Number three, we haven't had zero interest rates and rising to 5%. So a 5 percentage points rise in rate. I believe Thailand has been a lot less extreme on that. Also, remember, the Thai government never printed money and shoved it into the deposit accounts of banks and individuals. Remember, I said that the Silicon Valley Bank, part of it was caused by the government's action, responding to the 2020, crisis. And so I would say Thailand never did that. And so there wasn't this surge in deposits that forced them into a lot of government bonds. So it doesn't mean that the Thai banking sector couldn't have some damage or that the Thai banking sector has some risk. They definitely do. But they've survived this far. And yeah, I'm not too worried about Thai banks right now.
Understand.
All right. Other questions or comments?
As we speak, there's a problem with Credit Suisse right now.
And what's the
There's
problem?
news,
Credit Suisse had its audit delayed, right?
Yeah, the audit delayed, the report delayed, and now there's the biggest investors are saying they're going to They're gonna put more money in. No one's gonna put any more money in Credit Suisse, and people are withdrawing the money. It's happening.
Yeah, I mean, Credit Suisse has been under pressure for a while. Saudi investor rules out more funds. Okay, shares slide by 24%. Yeah, Credit Suisse has been pushed, to the wall. So I would say banks in Europe in particular are really at much more risk than banks in the US.
Reason being?
I think the credit quality in Europe is bad because of so many bad things that's been happening to the economy. And also the Fed basically got, basically the banks in the US were holding 40% of their balance sheet in zero risk bonds and cash. Now there's interest rate risk, but from a credit risk perspective, it was zero. And so I don't think that the European banks are in such a good position. And the Fed just has so much power to recapitalize them and stuff that, I don't know. I just feel like the European banks are in worse shape. But I have to do more work on that. I wish I could spend every day doing research, but I have to do other things too, unfortunately.
Interesting times we're living in.
Yes, we are living in interesting times. I think the key thing from our strategies is we're maintaining our 7% weight in financials and our 5% weight in our low risk strategy. But we will evaluate that and reevaluate that every day. We can come out of it if we wanted to, or we could stay in it. Look at Mercy. She just relaxing and listening. Getting ready for work. All right. Good. Well, any other questions? Okay. And we'll have the podcast come out, but it's basically what I just went through with you guys. And then tomorrow I'm going to go through inflation numbers and talk about that. And then I'll share that. And that will be the beginning of our chart books that I'm trying to create for the community. That is inflation, interest rates, and other things that we'll be having in the chart book. So you'll be able to access those. All right.
You will also get the updated Thai portfolio within an hour or so.
Exciting.
You'll get a message on Slack.
Exciting. So, all right. I need to sleep. Cop, would you cop?
Thank you very much. Thank you, everyone.
Yep. Take care.
Yeah.
Bye.
Thank you.